Today we have an incredible guest for you guys, Gino Barbaro from Jake and Gino, one of the foremost experts on multifamily investing.
We've transacted on over 2,500 units. We currently have a little over 1,900 right now. I've got enough real estate up and down the eastern seaboard that I don't need to make money. He came back to me the next day and he said, bro, I'm all in. Multifamily.
He is here today to join us to answer the one question that is on all of our minds. Gino, what is the best pizza you've ever had? Because you had a pizza shop for 20 years.
I like a thin crust. I like wood oven, to be honest with you. I like light crushed tomatoes, some fresh basil, just a light dusting of cheese on there. You cook it in there, 800 degrees, 3 minutes, flip it over, take it out, cut it nice and firm. You put it in your mouth. Best kind of pizza.
This sounds like a pizza that I need to try. And you have more pizza credibility and multifamily credibility than probably anyone else out there. You combine the two, there's probably not someone that knows more about pizza and multifamily put together.
I like that. Yeah. I'll go with. Well, that's why Jake and I, we called ourselves the pizza guy and the drug rep. That's how we met. I actually owned the restaurant years ago. Jake was a pharmaceutical sales rep coming into the restaurant, taking out orders and going to doctors' offices and selling pharmaceuticals and selling drugs, basically, vaccines, whatever he could sell to them. In 2009, the Jobs Act came and he's like, bro, I got to check out of here. And I'm like, bro, the Great Recession is killing me. I'm making more pizzas. I'm making less money. What do we do? I said, I like real estate. What about you? And he's like, Gino, I do like real estate. I've got this one doctor that I know. His name is Dr. Neshwat up in Carmel, New York. And he's the only doctor who's not selling out to these groups. And Jake, I asked him, why aren't you doing it? And Dr. Neshi said, Jake, I've got enough real estate up and down the eastern seaboard that I don't need to make money being a doctor. I love being a doctor, so I don't have to go out and sell. And I think when Jake heard that, he was young at the time, he was like, wow, the optionality of actually doing what you love to do and not being pressured, but having the vehicle of real estate allow you to do that, it clicked for him. He came back to me the next day and he said, bro, I'm all in. Multifamily. I said, when you move down to Knoxville, Tennessee, he moved in 2011, let's start looking for deals down there. And that's how Jake and Gino was born. Thanks to Dr. Neshwat, thanks to pizza, and thanks to GlaxoSmithKline.
That is hilarious. That is so funny. And what an origin story. It sounds like the beginning of like a superhero movie of how Batman and Robin came together or something like that.
And what's really cool about the relationship, we haven't changed that much. And, you can test your relationship with somebody by how much you make fun of each other. And if you listen to our podcast, we're always ripping on each other. And it's because we admire each other. I think we really respect each other. I think we really work hard for each other. We never make excuses. I never hear Jake say he's tired. The guy goes on vacation a lot, but he's always working. He never says, oh, I can't do this or I can't do that. And he knows, I think, unconsciously that the money he's making is helping feed my family. And I have the same admiration and respect for him. And he'll never hear me say, oh, I can't do it. Right before I got on the podcast with you, he sent me an email. There's 90-something units in a city in Tennessee. 5 minutes before, I didn't say, oh, Jake, I can't call this broker or talk to him. I'm jumping on a podcast in 5 minutes. Nope. Sent the email out, got a response while we're on, before we hit the record button. And that's my obligation and my duty to my business partner. And he has that same duty and the same obligation. And the last thing I'd say about it is it's because we have derived a relationship based on values. It's values-based decision-making. Our values align. Why do we pick multifamily? Because we want to build a scalable business. We want to build a business that pays us every month. And we want to build a business that we can control. We like hard assets. We didn't jump over to self-storage. We didn't jump over to crypto. We didn't jump over to single families. We didn't start flipping multifamilies. We both were on the same page. We both had the same values, the same objectives, the same goals. And that's why we've been able to continue to flourish with this relationship.
I've got two questions kind of on that topic. The first one is, I'd like to understand a little bit about what your background was like before you met Jake and you guys formed Jake and Gino, because there's an incredible story that begins there. I think 2011 all the way to 2026. So that's about 15 years. And we're going to have a lot to unpack there, but I want to understand who you were before that day. What were things like growing up? And in particular, what were you like as a person running that restaurant for 20 years, because most people get really complacent with the way that their life is. And if you've been one way and been doing one thing for 20 years, very few people, even when confronted with an incredible life-changing opportunity like multifamily investing in a market like 2011, most people would actually say, no, I'm good. That sounds like a nice dream, but I got this restaurant. I can never do something like that. But you had a mindset that actually allowed you to be open to that opportunity. I don't think most people would.
I don't want to curse, but just the word, I was effing pissed in 2008. I had a great upbringing. I made a lot of money in the restaurant in the early years. I worked with my dad. And when my dad passed away in 2007, things were tough. I didn't know if I was living his dream or I was living my dream. And then the fact that I felt like I was hiding in the restaurant, I was hiding in the kitchen. God gave me this opportunity. He gave me a great wife. He gave me a great business. I was doing well, and '08 comes and I start blaming everybody. I start blaming Obama. I start blaming Bush. I start blaming the economy. But why are there people out there making millions? They're not smarter than me. They may be better looking than I am, but they're obviously not smarter than me. They don't work harder than me, because if you've ever worked in a restaurant, that's all you do is work in a restaurant. So I couldn't figure it out. And then when I picked up the book by T. Harv Eker, The Secrets of the Millionaire Mind, I was like, wow, this guy is a real dick. But then I stopped and I paused and I read it a little bit more, and I'm like, he is absolutely right. Everything I've done up until this point in my life, it's because of all of the actions that I've taken. I need to be responsible going forward. I'm being sinful. I'm being slothful here. I know that I can do better. And I don't want to live a life of regret by saying, I'm okay. I don't want anybody to listen to this to think that they're okay, because you are created for something great, whether you know it or not. You have some unique talent, some unique ability. You may have been beaten down in life. I think we all have. I mean, I was running hard in '08. I mean, all of a sudden the economy crashes. Construction workers aren't coming in to eat. My taxes are killing me. The business is slowing down. I have 4 kids at the time, and I'd been doing something for 13 years that really worked. And all of a sudden that gets taken out from me. And I really had to swallow my pride. I had to really humble myself and say, what do I need to do? I've already done a couple of crappy real estate deals. Well, maybe I should learn how to become a real estate investor. And that's when I just said, I need to go back and I need to become educated. I need to learn how to really underwrite a deal. I need to learn the business of real estate. And that's for me where it started. And people will always say, yeah, well, you got lucky. Yeah, I got lucky that I met Jake. But if I met Jake without the skill and the understanding of do real estate, that relationship would be meaningless. Like, he wouldn't need me and I wouldn't need him. So you can call yourself lucky all you want. But when you put luck and you put preparation together, there's something that's pretty magical, something pretty cool that comes about.
Have you heard the quote, luck happens when preparation meets opportunity?
Yes, I was trying to think of what it was, and that opportunity word escaped me. But it really is true. Whenever you hear somebody say, oh, this deal just landed in my lap. Bro, nothing lands in your lap. You've been looking at deals for 6 months. You've been talking to countless brokers. You've done 6 property tours. You've sent out hundreds of emails. And then one day, mysteriously, somebody just reaches out and throws a deal your way. That's not how life works. Life works when you put a ton of work in it. I'm going to make a simple analogy. I'm Italian. I love food. The reason why my family left Italy was because being a farmer is hard work. That is the essence of entrepreneurship. You need to put in sweat, hard work on the front end. You need to plant the seed. Then you need to water the seed. Then you need to fertilize the seed. Then you need to pick the weeds. Then you need to train the tomatoes growing up. Then you need to pray to God that the weather doesn't ruin your crop. And then, and only then, after months and months of hard work, will you possibly be able to harvest fruit. And for my dad, one too many times, things didn't work out. He's like, I don't want to have that kind of life. So that's what life is all about. It's all about putting work on the front end, and then you'll realize the benefits down the road, and there's no luck in that. You've already prepared. You've already looked and tried to, get those opportunities done on the front end. So on the back end, they'll start showing up.
That's exactly right. And I think that there's some interesting ways to look at this, because if you want to go pure entrepreneurship and start a business from scratch and do something that's really, really entrepreneurial, it might cost you, I wrote a LinkedIn post on this the other day, it might cost you $50,000 or $100,000 or more of your own money, which you see on Shark Tank all the time. They ask them, how much of your own money have you put into this? And they never talk about how many hours have you put into this, because if you're making $100K a year, your time is worth $50 an hour. If you've put in 3,000, 4,000 of your own hours into some entrepreneurial endeavor, plus all of that money for nothing yet, sooner or later, something is going to hit and something is going to work. The skills that you've gained and what you've learned, you don't know exactly what day the opportunity will show up, but when it does, and it always will, if you're learning about the right things and taking the right actions and putting yourselves around the right people, opportunities will show up and you can capitalize.
Mm-hmm. Well, what you're doing with this podcast is a classic example of an entrepreneurial venture. The mistake that I made when I opened my first business, the restaurant, was I was opening it to provide for my family. I'm like, I need to make money for my family. And that's what most technicians, that's what most business owners do. They don't think about providing for the marketplace. They don't think about providing what I had said to you before we started recording on the podcast. This podcast, I look at it as a gift to the listener. I want to provide value to the listener. That's why I'm emotional. That's why I'm authentic. That's why I'm like full of energy. I love doing what I'm doing. And that's what every entrepreneur should tap into. Don't worry about making money for yourself. Worry about making money for your client. Worry about bringing value to them. And in the real estate space, it can be broken down into, if you're buying a multifamily property, you're buying it not just for yourself, but you're buying it hopefully with the intention of making it a better place for your residents. You're hopefully buying it so you can start building a platform of employees, property managers, maintenance techs. And the third one is, when you're raising money, you're also trying to bring value to your investors. You're really the last person that should be getting paid in that equation. Whereas most people flip it on the other way around, especially with syndication. Does the deal make sense? Not really sure, but I need to get paid. What do I need to do to get this deal over the finish line? Instead of saying, is this deal going to make my investors money? Is it going to make my employees better? Am I going to bring value to this property? If you do that and flip the script, you're going to have more likelihood of being successful. And that's what I see you doing with your platform. You're not worried about the downloads. You're not worried about making money. You actually went into debt to try to build something. That's entrepreneurial. You're not getting paid today. It's going to take you time to scale this. But with that being said, you've built a vision. You know what you want this platform to be. Your commercial real estate podcast. You know who you're trying to serve. And that's really cool. You're not trying to serve just Vince. Obviously, you do have to get paid. But if all you're focusing on is what can this podcast do for Vince, you're not going to be successful. And that's the same way in real estate. If you're out there just trying to do deals and you're not trying to be, valuable to real estate brokers, valuable to other property management companies, valuable to other people in the space, no one's going to want to do business with you. That's just the way it is. I mean, you can be self-serving at some point, but when people feel that, they don't want to do business with people like that. And it reminds them sometimes of themselves as well. So when you're out there starting a venture, start thinking about the value you can create and the services that you can provide, and ultimately the problems that you're trying to solve with the product that you're bringing out to the marketplace.
Real estate is a team sport. You can grow so much faster if you're in the right room. The Launch REI Mastermind is a curated space for investors who want to move from hands-on execution to professional portfolio management. This is your personal board of directors. Inside, our conversations go beyond the tactics. We cover the decisions that actually change outcomes, structure, tax strategy, and capital allocation. If you want to build alongside a vetted peer network designed for the long term, apply for the Launch REI Mastermind at the link in the show notes. And these are insights from someone who built I'm sure it's different today than what I have on here, but a $450 million multifamily portfolio.
Yeah, we've transacted on over 2,500 units. We currently have a little over 1,900 right now. And the little caveat that I like to put is those deals are primarily owned by myself, my business partner, Jake, and my other business partner, Mike. We don't have any more syndications. It's all of our own equity. And we've had syndications in the past, but our business plan, our business model, our KPIs have changed from the beginning. We needed syndication as a tool. We ran out of money. You start buying deals All of a sudden, you start refinancing these deals, but at some point, the capital starts to run out. And syndication, I'm grabbing the pen. It's like this pen. It's a great tool. It got us over the hump of trying to fund about 500 units. And after our third syndication, we're like, time out. Does this fit our model? Does this fit what we're trying to accomplish? Our KPI, Vince, 3 or 4 years ago, started focusing on what we call PPU, profit per unit. We wanted to really drive and build a company and build a bunch of properties that were focused on the profitability, whereas most people in real estate are focused solely on the equity. And the equity is truly important. That will make you wealthy. But I want both. I want the profitability and I want the equity as well. And when you're running a syndication company, you don't retain a lot of that profitability. It goes out to the limited partners, and you don't have a lot of the decision making, because when you're a syndicator, you're a fiduciary for the investors. You have to do what's best for them, not what's best for you. And that's the reality where people don't understand that. So when we're looking at it, we're like, PPU, we want about $250 to $300 in profit per unit after all the bills are paid. So how do we do that with syndication? We can't do that. We don't want to outgrow our infrastructure.
Interesting.
So for us, we just started, pivoting back to the capital that me, Jake, and Mike can provide for the deals.
What were the biggest drivers of the PPU, the profit per unit? Was it the purchase price that you guys bought it for, or was it adding value after you bought it? Was it bringing the rents up to market rent? Was it doing anything in particular, unlocking hidden value and rental income potential in the properties? Or what did you kind of find were the things that were really driving whether a property hit that range of 250 to 300 per door in profit or not?
That is a great question. And, if we zoom out for a second, I think it always comes down to the market cycle. 5, 6, 7 years ago, you could buy a property based on actuals and you can derive some profit per unit in that property day one, right? That's where the marketplace was. But if we take a look at where the market is nowadays, that profitability really comes with what our model is, the value add model. We're trying to buy properties, even if they're newer properties. In this part of the market cycle, we're seeing more of a value add component in the operational efficiency of an asset versus just fixing it, right? People go in there, they're going to think they're going to rehab the units, push prices up. That worked 3 years ago. Right now, there's a glut, an inventory of new builds. So if you're coming in with a 1970s product and you think you're going to rehab it and push rents up to close to where the A's are, that's not working in this part of the market cycle. So what we're trying to do, what we're driving it is we're not leveraging ourselves 80, 85% LTV. We're probably going to 60 or 65% loan to value. Number one. Number two, operationally, we know that a lot of these properties, when they're run with the expenses, we can probably drop the expenses down. And number three, you're looking at the income side of the equation. Well, we have non-refundable move-in fees. There's other income sources that we can generate. Obviously, there's something called ratio utility billing system in multifamily where the residents end up paying for their portion of the water. So that you're always looking at it from that perspective in this part of the market cycle, the operational efficiency. And for us, we've been able to do that. The problem with what we're talking about with PPU is we take a lot of swings. There's a lot of deals out there. We can't do a ton of deals a year because we won't be able to hit our metric. And that's why it's important for everybody listening to this. When you're getting into the business, you need to set up a buy right criteria. And that buy right criteria will guide you into the type of assets you're buying. So one of our criteria is that PPU. We're not going to get it day one. It may take us 180 days or may even take us 2 years to crystallize to that number. But we have enough internal data to know that if we're looking at a property in Knoxville where the median income is around $50,000 and they're renting it at $800 a month, we have assets in that market. We know those rents should probably be $1,200 or $1,300. We know that asset should get to $1,200. We're not making a call where we're saying, well, we hope. We already have the data. So that's how we're able to really pinpoint and locate what that PPU is. And for anybody listening right now, start focusing on what your metrics are. If you're just starting out and you're just getting into real estate, don't worry about PPU. Worry about building equity. Worry about creating the equity, because once you exit and crystallize that equity, that's your equity right there. That's when you start building and start putting that equity into other deals, and that equity starts creating the cash flow for you.
If the listener is hearing all of this right now, they're probably thinking, wow, there's so much experience and wisdom in all of this, but they might be thinking, Gino, that sounds great, but how do I create equity?
How do you create equity? Where should we start?
Yeah,
Excellent
there's a lot of
question.
ways to do it, right? It could be if you're buying it off market and getting a little bit of a discount, especially if it's a little bit of a hairy deal and maybe they just want to get rid of it. Maybe there's some seller distress and you're able to benefit from that. Or there could be other opportunities like maybe it probably wouldn't be something like charging for parking, but it could be charging for storage. Maybe there's down rental units, maybe there's down storage units, or maybe there's space for storage that the tenants would pay for. Maybe there's laundry. Maybe the utilities could be billed back to the tenants. There's probably so many ways here where you're boosting the NOI, which then is going to really translate to having an enhanced equity position. But I'm guessing because I don't have the experience that you do.
Those aren't guesses. Those are all great answers. I'd like to put one caveat on that because we're talking specifically multifamily. For me, when I started, it's once again, how do you create equity? The right question or the different question could be, how do you create value? And I'm going to give you a quick example because this is important. You had heard me mention my business partner, Mike. I met Mike on our second deal. He used to come into the restaurant. He's a hedge fund trader in Connecticut. I had my restaurant. He'd come in. He had these nice Bruno Maggi shoes. He'd sit down in the front. He was picking up takeout about 2 or 3 times a week. And one day I was sitting up front. I had my pizza coat on. I had a little pizza sauce stain on there. And Mike just starts talking to me about gold and oil and China. And I was ready. Once again, luck, preparation. And I think he was a little taken aback. He's like, how do you know all this?
Oh, he was probably shocked, right? You don't expect your pizza guy to know anything about those things.
That's right. And I said, Mike, I'm investing in real estate. We just bought our first asset. It's generating $13,000 a month. We paid $650,000 for it. He's like, really? I just bought a $2 million home in New Canaan and I'm only getting 10 grand a month. Bing, 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 bing. Doesn't take a rocket scientist. I'm generating 3 grand a month more with 1/4 of the investment or 1/3 of the investment.
And that's efficiency, which is what you were just talking about.
And right away, I piqued his interest. I created value for Mike because Mike is full-time. Mike cannot do what I'm doing, right? He's doing his full-time job. It's value for value. And the cool thing about this was on our third deal, we had our third deal. It was 136 units. It was a $4.025 million purchase price. This was back in 2014. We still didn't have the money. Jake is hitting up his grandma. I'm hitting up my mom. We don't have any money. Mike lent us $500,000 to the partnership for 5% interest. When we refinanced the property, we paid Mike back the $500,000. But what was really cool was Mike diluted himself. It was a loan. So he gave us, we had to come out of pocket 5% less for the down payment. So the down payment was only 15%. And 5% was the loan. So he actually did us a huge favor. And then we leveraged his balance sheet. So when you're talking about how do you create equity, you create equity by figuring out what you love to do in this business. If you love to raise capital in this business, you can create equity that way by bringing equity to deals. If you love to property manage and you're a boots on the ground kind of person, boy, you are in luck because most people suck at operating deals. So if I have a 50-unit deal in a market and Vince comes over to me and goes, Gino, you know what? I don't know how you want to structure this, but I will work for this property. Maybe you give me 5% equity. I'll only charge you 3% on a property management fee. The property manager is going to charge you 10, but I've got equity. I've got skin in the game. Let's try it out. And Vince is going to say like, you know what? That doesn't sound like a lot. I'm only getting 3% and I'm only getting 10% equity. But if you do a damn good job, guess what? The next deal that Vince comes along in that market, he's going to like, Gino, do you want to be in on that deal? Yeah. That's how you create equity, by creating value if you don't have any money. Right now, obviously, if you have money, don't delude yourself into thinking, well, great, all I do is need money. I had plenty of money when I first started out. A person with money meets a person with experience. The person with the experience gets the money, and the person with the money gets the experience. I lost a lot of money on my first couple of deals thinking I knew it all just because I had money. Money is not the end all be all. It's great to have, but if you don't understand how to run a multifamily business or any kind of business, that money, you're going to light it on fire. So don't think that money's holding you back. Money's not holding you back. Solving problems, creating value, thinking outside the box, bringing solutions to a deal, that's what's holding you back if you don't have those skills.
There's so much gold in that. That's just such great advice. I think that there are a lot of people out there that have money and they might think that they know what to do with it or how to control it because they're competent at what they do that earns them a very high income. But if you look at the percentage of people that are living paycheck to paycheck, or even the ratios of how much wealth they're building based on their income, a lot of times people that are higher earning are not necessarily more efficient than people that are lower earning, because people tend to raise their spending as their income goes up. And it does take a separate and different kind of education to know how to manage capital effectively. But when you were doing your first deal, I believe that was in 2011 in Tennessee. I want to go back to that moment. If you could remember how much you had to put in, what did you know? What didn't you know at that time? And more specifically, how were you feeling? Because I would imagine there had to be a lot of fear there, maybe still a lot of anger from some of the things you had experienced in the economic downturn. You were still kind of in the depths of it in 2011. Let's go back to that time.
We partnered up in 2011. It literally took us 18 months to find that first deal. There's a couple reasons why. The first reason was that Jake was a sales guy, and he thought that the brokers owed him something. He was like a bull in a china shop, always posturing up, always getting a little aggressive. And we figured out, Jake, you can't do that because the brokers are the gatekeepers. You can't keep burning them out. I can't keep hearing y'all ain't doing business in Tennessee. I heard that long enough. It took us 18 months. We finally got in touch with a really good broker, and we brokered our next 6 deals with this broker. He was incredible. He took us under his wing. He taught us really how to get into the multifamily space. And for me, there is fear. There is fear of the uncertainty, but I had more fear of not taking action than I did of taking action. And that first deal, it cost us $600,000. It was a 25-unit deal. It was 80% bank financed. We got 10% seller financing, right? It was great for the sellers because they didn't need all the money. They got $350 a month paid to them. Remember that whole idea of, well, it takes money to make money? Well, we just created 10% out of thin air just because we knew how to do that. And 10% we put as a down payment. The down payment was $83,000, and it was me, my brother Mark, who was in the restaurant business, and Jake. So we each came up with $27,000 to take down a $600,000 asset. The irony is we still own this deal to this day. It's still making between $8,000 and $10,000 a month in cash flow. And we refinanced it back in 2015. We pulled out $165,000. So we put in 80, we pulled out 165. And the great thing about this deal was it was our first deal. Everything that could go wrong went wrong. Person died in a unit. We got sued for bed bugs, weekly renters, septic system blew up, but it was small enough that it didn't kill us. And it was big enough that it gave us the ability to learn and the ability to make money on it. Like I said, it was $13,000 a month that we were generating in revenue. We got that quickly up to, over $20,000 a month within the next year once we recycled all the bad tenants out, once we took out a lot of those expenses. And that's where we started. It was our very first deal, but we liked the market, we liked where it was located, and we knew that we could add value to that property.
And then you guys really scaled up from there, because I think after that in 2015, you bought a 281 unit property that was seller financed. So you started to get into some pretty large deals. I think people tend to maybe go a little bit slower than that. You guys must have felt like you had the systems down and the confidence to operate an asset that was that big. Did you started to kind of come up with some principles of, we know that if they're asking this, the rents need to look like this, and maybe you had some process for vetting what the operating expenses looked like and how much you would need to have in capital reserves. How did you kind of approach it as you were starting to hit this scaling level?
It is a great question. And I had referenced my business partner, Mike. What Mike brought to the table was the understanding and the ability of business, of really analyzing income, analyzing expenses. And that's what real estate is. It's income over expenses. That 281 unit deal, it was totally seller financed. The down payment was seller financed 20%. The bank gave us 80. Mike basically said they're giving us the keys for free. It was incredible. The first month, it generated $140,000 a month in revenue when we took over. The first month we had it up to $170,000 a month in revenue. We saw the inefficiencies. We saw where rents were. We saw that there was a little bit of stealing going on. And I really credit Mike early on by taking Jake and myself under his wing and really teaching us the numbers on real estate. You can underwrite a deal, but understanding the value and understanding the vision behind the property, he was really good at. Now, we did 25 units on our first deal, 36 on our second deal. Then our third deal, we jumped to that 136 unit, which was $4 million. But the fourth deal, we went back down to 22. And that 20, we own all those properties still. Then I think from the 22, then we went to 281. And the 281 it was a massive deal. It was a really big deal. But we were able to structure with the seller financing. And we're like, okay, if it doesn't work out, can we sell it for 11 million? We thought we could, because we could break the assets up and sell them for more than the whole part. So was there risk involved? And you bring up a great point about scaling. We had a gentleman that was working with us as well. What's his name? I can't remember his name. Mobile home park guy, Jim Clayton. So Jim Clayton, he's the guy who sold his mobile home park business to Warren Buffett back in the mid 2000s for billions of dollars. Jim Clayton's bank was financing this 281 unit deal. And he sort of mentored us as well, teaching us, he's like, Jake, you can't be the IMA guy. You can't be going to the bank and depositing checks. You got to get a check scanner. For instance, one little tip that he gave us, but he was there helping us with the systems as well, because he's like, my bank's putting money into this thing. I want to see you guys succeed. But having these people outside of your sphere and saying, oh, by the way, we're at 500 units. We've never scaled the business. It's not like you come out of your mother's womb learning how to scale companies or buy assets. We went back to the drawing board and we hired a company to help us scale and to help us build these systems. But to get to that point, it was rough. It was challenging. And I remember getting to that 500. Once we took that deal down, our lives were completely changed after we took that deal down.
And this is where things start to get really interesting, because the market is good at this point. It's appreciating. There's still deals to be found. And I think in 2015, you reached 1,000 units and also released the wheelbarrow. I can't even say it. Wheelbarrow. If I say that wrong, wheelbarrow.
Yep, wheelbarrow.
I never even say that word. Wheelbarrow Profits podcast and book about multifamily investing.
Yes.
And then in 2018, you hit 1,000 units under management with the refi and roll strategy. That's something that I don't think I've heard of. Is that just another term for the BRRRR strategy, or is that different?
I think we came up with it before the BRRRR strategy, because it's like, what I want people to understand is that, you're refining this deal, but I want people to take that money and roll it into the next deal. And I was fortunate, Vince, because I was working at the restaurant while I was doing the real estate. I was in the restaurant for another 5 years, and I was able to live off of the restaurant income and be able to pay my bills through there. And all the money that I made with the real estate went back into the real estate. Now, was it challenging? Yes. Was my wife pissed at me sometimes? Absolutely. Did I miss a few things with the kids? Of course. But if I wanted to be here and not think about sacrificing while I'm here, it may take me a lot longer to do that. And I didn't want to burn the bridge of that income coming in, because I needed that income to support my family. So I just said, hey, it may take me another year or so to do it, but let me just be a little bit more, what's the word? I want to be a little bit more responsible and not just get rid of the restaurant and try to stay there as long as possible until I was generating enough cash flow and income from the real estate to say goodbye to the restaurant.
This episode is brought to you by Easy Street Capital, the lender built by investors for investors. Whether you're flipping, building a rental portfolio, or executing a ground-up construction project, Easy Street has 3 nationwide loan programs designed to close fast with no surprises. We're talking 24-hour closings, upfront terms, and in-house servicing from start to finish. If you're ready to fund your next deal, go to easystreetcap.com/launch-REI to get started, or you can grab the link in the show notes. It's really smart that you were able to reinvest all of that capital, because it does really help the business grow faster if you don't have to live off of that. And I think it's
so tempting to buy a Lambo. It's so tempting,
isn't it?
To buy a Porsche. It is, but once again,
I don't know what that feels like. I've never had the option.
Yeah, that's not, you're lucky. Well, you know what? Now you look around, that's not in my values. I want the asset to pay for that. I don't want to take the money from the asset to pay for that and then not have any money for the asset. That's the way my mind was trained. That's the way I was raised. And that has served me really well. So I'm like, you know what? I can hold off. If I never get it, that's fine. I just want to continue to build the stability and to build a foundation of assets so that at one point, if I want that, I can have that.
And you did the opposite. I think in 2019, you reached 1,500 units. And also you were starting to get into a more diversified kind of life at that point. It was beyond just real estate and even just pizza. You started to get into the philanthropy, making a difference. You started to give back your education and your knowledge through books and the podcast platforms, multiple podcasts that you had. And you donated over 100,000 meals by that point in 2019 as well. What inspired you to do that and make such an impact in that way?
Well, there was a lot of personal development work going on. And I realized through life coaching, through therapy and all this, I realized that I think everybody on this planet, when they rip down what their sole purpose is and what their why is, I think most people, when they're asked that question and they have time to reflect, they just want to help other people. They just want to share what they got. But it's really hard when you're focused on having 6 kids and paying bills and getting beat down and working the W-2, and you're always focused on money, because that's what my life was up until 2016. I was focused on solely paying for my family. But once I was able to become financially free, all of a sudden that sort of pressure was released. And I'm like, well, I can do these cool things. I can write a book. I'm not going to make any money from writing a book. I can start a podcast. I'm not going to be able to monetize that, but that's a lot of fun. I can share and I can start having these conversations, and I can start employing what Bob Berg calls the go-giver, that go-giver model that he wrote that book. It's a great idea. Most of us can't do that because we're so focused on ourselves, because we have these pressures. But when 2019 came, I'm like, I can chill out a little bit. And I was doing it before, don't get me wrong, but it's at a different level. When you start focusing on and start building content and creating content and giving the gift and serving others, it's not so much about how much money you're making. Money is a result, right? That's what it comes down to. Money is made to create an impact. And that's what I realized once I became financially free. The struggle to become financially free was pretty clear. I don't want to worry about paying bills. I just want to have enough optionality to say, oh, Vince has got a podcast today, I'm on it. Or I don't want to be on Vince's podcast. I can make that decision. That's what I wanted from financial freedom. But ultimately, once you get that, then you start saying there's other things in life. It's not just about me. And getting those emails and having people quit their jobs and having people close deals, there's so much satisfaction in that. Maybe a little bit of pride. I don't know, but you feel good. But I know out there, the mission that we have now is we want families with financial intelligence. They can change the world for the better. And if I can help families do that right now, I may not be making a ton of money doing that, but man, there's some soul purpose living for me in there. And that's what really drives me. And that's what makes me excited.
You're really aware that we only have so much time and that work takes up so much of our time, and that if you can educate yourself financially and if you can use real estate to get to a position of financial freedom, you have optionality. You can do what you want with your life. And maybe you're like that doctor who loves medicine and would do that anyway. But there's a lot of people out there, most people I would guess, that if they had passive income or semi-passive income from real estate covering all of their living expenses, I don't think that they would still be doing their job today. And that's the whole purpose of real estate. It gives you at least the option to make that decision rather than being forced to do something that you don't want to do.
Vince, it's interesting. And this is for the listeners. You don't have to go out and acquire 1,000 units in the next 2-3 years. If you do even one deal a year, in the next 5 years, you look back and you'll have done 5 deals. Even if you do one deal every 2 years, if you look back in 10 years, 10 years goes by. We're 6 years post-COVID. So let's put that into context. If you did a deal a year since COVID, you'd have 4 or 5 deals. Those 4 or 5 deals can set you free for life. It's amazing what they can do. But we're so inundated and we're so worried about, wow, I've got to get to this number of unit count. Don't worry about that. You put one foot in front of the other. You try to understand what you're trying to accomplish, and you take those baby steps. I mean, you could start investing passively as an investor. Start investing passively. Start learning the business and start earning while you're learning. That could be the first step. I didn't have that opportunity when I started because I didn't know, but that's a great way for a high income earner to get into it. And then once you see a little success there, you invest in another deal. And then maybe that third deal, you say to yourself, I could do this or I could help a team. So then you start investing in somebody's team and start bringing value there. And then on the fifth deal, you may be like, you know what? I'm getting pretty good at this. I may want to buy my own JV deal.
I really like the angle that you have of there's different ways that you can do this, because I think it's really easy for people to fall into a trap of thinking, I don't have a 25% down payment for a $2 million multifamily building with 100 units, so therefore I can't do it. And that's not true, because there's different components to the deal. Not everyone is good at every part. Not everyone has to do every part. You could raise the capital. You could be the person that looks for off-market deals and talks to the sellers.
Yes.
You could be the operator and do the work. And you could structure these deals so that you own a third of it or half of it. You could have seller financing cover a big portion of it too, right? So there are creative, strategic ways that you can do this, but also you can start small. You could start with 8 units or 10 units. There's ways that you can do that, and you can do it in other markets, maybe with a partner who is boots on the ground there. There's so many creative things that you can do to just get on the ladder of real estate investing.
And that's a great analogy, getting on the ladder. Before you get on the ladder, you need to make sure what kind of ladder it is, and you need to make sure the destination of how high you want to go or where you want to go. Because Vince may only want to go up to the second floor, but John may want to go up to the 5th floor. What do I mean by that? Well, Vince may just be sitting there and saying, I've got a great job. I just want to put some money into real estate to retire, have some retirement income coming in. Where John is like, man, I can't stand my job. I want to quit tomorrow. Well, John's got a different path. So you need to understand what your goals and what your objectives are. And then you couple that with the income that you have, the capital that you have, and the time that you're willing to commit into this venture. So that's why you have to pick the right ladder, and you have to understand for yourself, we're all unique. We're all different. That's why for me, I jumped into multifamily right away. I had a job. I didn't want to fix and flip. Fixing and flipping is great. If you're in corporate America and you've got time, you can go fix a couple of homes, make an extra 50, 100 grand a year. You put that money aside. Before you know it, you have 300 or 400 grand saved up. Then you can go buy a 10 unit. That works, but I couldn't do that. I already had this soul sucking job. I didn't want to replace it with another job. That's why I chose multifamily. I knew the direction, and I knew that ultimately I wanted to leave the restaurant. So I had a certain amount of time, and I had a certain, path that I wanted to choose. So if you're listening to this, figure out what it is that you want real estate to do. It's just one vehicle. There's so many vehicles out there that can take you from point A to point B. And Vince, the reason why I'm saying this is I have nothing to sell. I think what you said is great. There's so many different ways. Learn all of the tools: down payment, seller financing, master lease options, syndication, JVing, partnerships. These are all different strategies and techniques. They work at different parts of the market cycle. That's why the more you learn about becoming an investor, the more options you have, the more likely you'll be successful in closing deals.
There's a couple of interesting things that you did to dip your toes into some slightly new aspects of real estate over the last few years as well. So I do want to touch on them. We had talked a little bit about how you guys are still holding onto properties where you own them all in the small partnership you have and not the syndications. You did do a syndication in 2020. Can you briefly walk us through what that experience was like?
Yeah, we did 3 syndications. We did
3 of them, okay.
Yeah, I think we did one in 2018, one in 19. I think we did one in 2020. Now we've exited all 3. For us, the syndication was a little scary because we are control freaks and it is a different business. That's why I'm saying right now, all of a sudden, if you're looking at this and you're young, there's asset management, there's investor relations. That's part of the syndication business. And, you can look at that. So for us, we're already running these properties. We already have property management going on. We already have acquisition going on. We went on and we hired somebody or partnered up with somebody to help us with the syndication. And we did 3. But then by the time we had the 3rd one, we had over 100 investors. We were doing webinars every month. It was a lot of work to do that component to the business. And it's like, there's that component and we're getting paid less. There's less profitability because all of a sudden we have less money into each deal. And once again, Jake and I like to hold these deals long term. Most syndications aren't structured for long term holds unless you tell your investors, hey, guys, we're going to hold this deal for the next 7, 8, 9, 10 years. Not many investors are savvy enough to understand that that may be beneficial to them. They're looking for their capital back in the next 2 to 3 years. So that was one of the major reasons why we said this syndication is not, it's hard for us because we put all this work into a deal. We get it to where we want to. We want to exit it through a refinance, but most syndications go with selling. We just killed a golden goose, and we got to go out and find another goose and do that all over again.
It sounds like patience is one of those core principles that's really important to you in this.
Yep. It is patience and really being clear and having a great understanding of what it is that you're trying to accomplish. Now, don't get me wrong. If there's a deal that comes around that's $70 or $80 million and it's a life-changing deal and we don't have the capital, we will get partners, but we will be upfront with the partners. And this is something that I think any investor listening to this is just be clear on the parameters where we tell the partners, hey, we're not looking to exit this deal in the next 3 or 4 years. If you're good with that, let's do it. If not, I don't want to be part of this partnership because this deal is going to change our lives. And maybe if we hold on to it long enough, it may change our kids' lives as well.
That's fantastic. In 2022, you started to pivot a little bit into something new, which was development. What does that business look like today, and what kind of opportunity did you see?
I was joking around on a podcast the other day. I have mad respect for developers. It is such a hard job. That's why when they get it right, they get paid a ton of money. Picture and imagine you're buying land today. You're 3 to 5 years out before making any profit. Can you tell me where rents are going to be in 3 months, let alone 3 years?
No way.
Can you tell me where interest rates are going to be in the next? It's really challenging. Now, we were fortunate because we leveraged the Jake and Gino platform to get in front of brokers. Brokers brought us 2 land deals during 2021 and 2022. Fantastic basis. We just bought them. We didn't know what to do with them. We put them on our what we call our imaginary conveyor belt. They sat there. We did a little land banking. Over the last 3 years, we've been able to get one prepared. Final permits are almost done after 3 years. 261 lots we have on this thing. We're in contract to sell it to a builder. If it was smaller, we were thinking of dabbling and building ourselves. But once again, if we start doing that, it's going to take away from the component of managing it. But we would do it for a build to rent. So we'd build these things and then own them. But let me tell you something. Mad respect for developers, and it is a tough business to be in.
There's not too much information that I found over the last 3 years from 2023 to 2026 now. I would love if you could kind of fill us in over what these past years have looked like for you, the past 3 years in particular, especially in this higher interest rate environment, more challenging affordability. Rents have not risen to the level that the home prices have. And that has made things pretty challenging for a lot of aspects of real estate investing. And there's also a lot of multifamily syndicators who have gotten the rug pulled out from under them because they were forced into a refinance where, they've got these higher rates, it doesn't cash flow anymore, and maybe the equity's not there, but they're forced to sell. Are you starting to see opportunity come back? And what kind of things have you been working on real estate-wise and personally over the last 3 years from 23 to 26? I know you've written a few books, you've got several podcasts, so there's several areas that you're pretty involved in.
Well, for us, we've been very fortunate. 2023 and 2024, we were able to buy in excess of $25 million in real estate. Last year, we bought $15 million in real estate. And for us, what I'm seeing is there's still a dislocation between what sellers want versus what buyers are willing to pay. And that's the reality. The reality is we've been in this 2009, 2010 limbo area where there's the lending is tightened up and sellers are just still thinking about prices back in 21 and 22. Now, if they don't have to sell, great. But the only way you get a deal in real estate in any facet is you need a motivated seller. That's the only way. And they're not motivated. Now, on my side of the ledger, fortunately, we did no bridge debt. We only went with longer term fixed rate financing. So for those of the listeners out there who don't know what bridge financing is, back in 21 and 22, a lot of people did what we call bridge debt. They took on debt that was, had a 3-year term and possibly 2 1-year extensions. Now, financing and rates were low. What happened the next 3 years? Rates exploded. So you're at a 3.5% interest rate in 2022. Now in 2026, you're at a 7% interest rate. Rents haven't gone up as much as they should have. So there's an opportunity. They can't kick the can down the road. There's going to be a lot of opportunities, especially in the Sun Belt, especially in parts of Texas and in parts of Florida, where they employ this bridge debt, where you're going to have an opportunity because they cannot refinance these deals. A lot of this seller equity and limited partner equity is going to be wiped out. So we're looking, there's going to be opportunity, and they can't kick the can down the road anymore. So it's a positive thing for multifamily. The market needs to reset. That's where we are right now.
All of the real estate that you bought in these last 2 years, those are massive numbers. What areas did you buy them in, and how many units were they? What does the composition look like of the real estate that you guys have acquired over the last 2 years?
That is a great question. Newer assets. They're in Morristown, Tennessee. They're more in the east part of Tennessee, but they're 2019 build, 2022 build, 2024 build. And the 30 units that we just closed on in December of last year was an 82 build, but 2-bedroom, 1.5 bath townhomes. So we're more going into the townhome style and into the newer assets. And we're always focusing on median incomes that are at least 50,000 or more. We want to have a more less challenged resident base. That's what we're looking for.
Got it. Okay. And you did become a certified money coach, and you launched Barbaro 360. Could you talk a little bit about what pulled you in that direction and what kind of impact it has in people's investing, the mindset that they have around money and how they think about money, their relationship with personal finances?
I read a book by Morgan Housel probably 3 years ago. It was called The Psychology of Money. And it's just a light bulb went off. I'm like, wow, why can some people attract money and have a decent relationship and not feel guilty and do pretty well and understand what money is, versus others who are an absolute train wreck? It doesn't seem like they can even get out of their own way around it. I wanted to understand why. And, the whole idea and the science behind the behavioral aspects of money has really intrigued me. And it's had me go back into my past and see how I had what we call these financial flashpoints. These like memories that we have when we're younger. They're embedded in us. They can be positive or they can be negative. And that memory is just written into our soul, into our psyche. And as we get older, we start acting and continue to act on those old patterns and those old behaviors unconsciously. So as you can see, most of us grow up not talking about money. Money's never taught in school. I think that's probably done on purpose. We're just financially illiterate. And we're supposed to learn about money, and we're supposed to know about money. And men are supposed to know how money works. And when we don't, there's shame, there's fear, there's anxiety around it. No wonder why this country is dysfunctional with money. It's such a taboo subject because nobody talks about it. If you grew up in that in that family, it's challenging. I grew up in a family where there was fear around it. We were immigrants. We needed to save for a rainy day, never for a sunny day, only for a rainy day. I was always conditioned to have money set aside just in case, never really to enjoy it. And when I started buying these assets, I was like, wow, I need to enjoy my money a little bit. I need to talk to my wife about how she grew up with money versus how I grew up with money. And that whole psychology, that whole relationship, a big piece of that affects us as investors. And like you said, if I got into the space saying I need money to make money, well, then I probably would never take any action because your behaviors are belief driven. But if I could say to myself, wow, I just did a seller finance deal and we just bought 281 units with no money. That changes the whole relationship and the whole understanding of what money really is. So I would challenge anybody listening to this, go back and do yourself a favor. Just reflect upon any stories that you have early on. Did you go to the grocery store and your mom said, we can't afford that, put that back? That puts a big imprint on a little child. So when you get older and you see something at the store, you may get that emotional twang back saying, you know what, I can't afford it. Even though you have money, you just had that emotional, connection. My connection to money when I was young, I went to work with my dad when I was 8 years old. I came home, he gave me $2 in front of the whole family. Everyone's pumping their hands and going, hey, great job, Gino. And I equated hard work, money, adulation. So that was sort of imprinted and wired into my psyche early on. So, as you're listening to this and you shut the recording off, just reflect upon your money bio, reflect on some of those stories and see if there's a connection between back then to today. They're not all negative. Some of them can be positive. We had some positive stories. And once you start seeing those patterns and those behaviors and the beliefs, you may start making some connections upon the decisions you've been making about investing and growing your portfolio.
What do you think is the best financial decision that you've ever made that had nothing to do with real estate?
Probably marrying my wife. She stayed at home, raised the kids, homeschooled. I didn't need a cook. I needed a teacher. I mean, I'm saying that facetiously, but I mean, if you think about it, we're on the same team. Like that was the thing. We had, once again, our values were aligned. She wanted to stay home and raise a family. I was the breadwinner. Brought a lot of conflict because I was the one who was always handling the money, making those decisions. And she was more of what we call the innocent in money coaching. She didn't want to know anything about it. But as far as the financial decisions, it was great because we both loved what we did. And oh man, she's just an incredible partner. Would not have been able to do what I've done without having somebody like her in my corner.
That's amazing and complimentary. And they were able to take care of so much stuff on the personal side of your life so that you could really focus on scaling everything that you did on the business side, which overall benefited both of you. It's teamwork. Mm-hmm. You've shared so much with us today about multifamily investing, around money psychology, and around what's possible, finding complementary partnerships, and knowing that you don't have to do everything in order to start or scale a significant real estate portfolio, and that you can actually build a pretty meaningful portfolio in 3 to 5 years. And so there's just so many incredible things that we've touched on. Where can people learn more about you or follow along with Barbaro 360 and everything that you're putting out there to teach people about money and real estate?
I would love just to tell people and to navigate to the website. It's barbaro360.com. If you want to learn more about real estate, we have the Jake and Gino website. We have our podcasts on there as well. But Barbaro 360 is where we're just providing a lot of the content there. I've got a show podcast with my son who's 23 years old. We do something with money. I have a podcast with my wife centered around family, communication, spousal relationships. So just go to barbaro360.com.
That's so good. You're just full of so much incredible knowledge, wisdom, and experience, and it just really shined on the show today. I mean, I'm just looking at the notes that I had, and we could have easily had another solid hour and a half of just amazing content going really deep on multifamily or more into finances. And there's just so much that we'll have to save it for next time. So thank you for everyone who's here today for, listening and joining us. And Gino, we really appreciate your time. Thank you so much for sharing all of your experience with us today.
Thanks, Vince. Appreciate it, brother.
Thank you. If today's episode was useful, subscribe so you don't miss what's coming. We drop 2 episodes every week. And if you want to go deeper, join thousands of investors getting our free weekly newsletter at newsletter.launchrei.co or check the link in the show notes. See you next time.